Good morning, everybody, and welcome. I hope you've enjoyed the first day of the conference. This morning, we're going to try and tackle the question that we began with yesterday in a slightly different way. Is the world going back into crisis? By that, I mean, are we going to do another one of those very big stock market crashes combined with a global recession? And the answer is, I don't know yet. However, you're going to help me decide what the odds are. So pay attention because there'll be a vote at the end. There are so many different areas of controversy and uncertainty. We're addressing a lot of them at the conference today. Later on, I'll be helping to moderate a session with Sir John Major on Brexit. That's just one of a very long list of uncertainties that the world is dealing with right now. I think to get some kind of perspective on where we are and what the context is before we take our vote, I want to take you back through history a little bit. I want to talk about what the history of the three great crises of capitalism of the past can tell us about where we might be going. And I want to try and highlight what I think the answer to this question really depends on. And if I have to boil it down to one thing, it is policy and whether policy actually rises to the challenge that we face right now. So let me start with a bit of context, which goes back to the Credit Suisse Global Investor Risk Appetite Index. This is an index of investor sentiment, which I pioneered back in 97, 98. We've been using ever since, potentially as a contrarian indicator. And here you can see the history of investor sentiment back to 1981. And the high readings we call euphoria, and the low readings, what we call panic, are periods when we think investor sentiment is either unusually optimistic or unusually pessimistic. And you'll notice that we started this year by going into quite a deep panic. We actually had the first little whiff of panic back in September last year. We just dipped into the panic zone. But in January and February of this year, we were in quite deep panic. If you look at the history of what transpired afterwards, after panics in the past, there have been about 16 of them, 16 different panic episodes since 1981. And what we see at the top is the performance of MSCI World, global equities, post-panic. And here we've shown 6-month returns, 12-month returns, 24-month returns, and 36-month returns post-panic. And you can see that from the 1981 to the 1998 episode, it was always a good idea to buy in panic. Of course, it was always true that very few people did buy in panic, but nevertheless, you were rewarded handsomely for taking the risk of buying when everybody else was afraid. You'll see that there are two kind of periods highlighted in red here, where actually buying in panics was arguably premature. And those episodes were the beginning of long and complex unwinds of a bubble that led eventually to a global recession. Those of you who have been following the work we do with global risk appetite will know that on the whole, risk appetite is pretty correlated with global growth. So underneath the returns on MSCI World, you can see what happened to the level of global industrial production as a measure of global growth. And you can see that in the red boxes, you had global recessions and underneath. So essentially, it's in this history, which is quite a long history, it's always been right to be contrarian in a panic, except when you're at the beginning of an unwind of a long and complex bubble, overvaluation, over leverage period. So we can change our question. Is what we're seeing now the beginning of a complicated unwind of a series of imbalances, overvaluation, over leverage, so on in the global economy that is actually going to take the world into recession, or not? Okay, so you're ready to make a little vote? Let's just have a preliminary vote. And you don't have to actually be 100% convinced. You just have to say, well, if push comes to shove, do I think this is the beginning of a sequence that's taking the world economy into recession, and it's going to take a long time to work off all the bad things that we've built up over the period of the expansion. It doesn't matter what you think they are. So if you think that it is likely, more likely than not, that this is just the beginning of a long process that's going to take the world economy into recession, please raise your hands now. And if you think it's less likely, more likely than not, that we're not going into recession, the world economy has still some room to grow and so on, please raise your hands now. Okay, this is Asia. So seasonally adjusted, that was just a marginal no. Okay, so that's where we start the discussion. Here's a little chart which we can use in real time, perhaps, as a very kind of heuristic gauge of keeping score. It's a very simple chart. It shows the open, high, low close of the S&P 500 on a monthly basis. And it's got a moving average on it. It's a slightly unusual moving average. It's a 20-month moving average. Why in heaven's name would you have a 20-month moving average? Well, there's a very simple reason. The cycle in global industrial production growth, what I call the inventory cycle, what Keynes called the trade cycle, tends on average is roughly 36 to 40 months. And the same is true for the global investor risk appetite cycle. It's a roughly 36 to 40 month period. So the half-life of a global industrial production cycle is about 20 months. As a very kind of rough gauge of how equity markets are doing, you can use the 20-month moving average to keep score. If the S&P is above the 20-month moving average, we're kind of okay. Once it starts to fall below, you start asking questions. And if you look at this chart, you'll see that there are some periods where we have dipped below it, kind of found our feet again, and the bull market has resumed. So even when you look at the 1987 crash, which is on the far left of the chart, you can see that. You can see that we just dipped below in 1998 when we had the crisis with LTCM and Russia. You can see that in 2011, in this cycle, we dipped below and then we resumed. Well, we clearly dipped below at the beginning of this year. And by contrast, you can see that at the peak of the tech bubble and at the peak of the 2007-2008, prior to the Lehman crisis, you can see that once we dipped below the 20-month moving average, we kind of rallied back to test it, failed, and went straight back down again. Well, the good news is that we poked our heads above the 20-month moving average in response to in the recovery from the panic of January and February. in response partly to policy initiatives. I could say really in response to the G20 meeting in Beijing. We've actually managed to push just above that level. So one of the things that can maybe tell us that if we're keeping score, we didn't just rally back up and then fail immediately. We actually bounced hard and went above the 20-month moving average. So a very loose way of saying that the option that we aren't going back into full crisis and recession is still available. Let's just put this into slightly more economic context. When I think about the risks to the world economy, to asset markets, whether the bull market is over, I tend to look for a number of indications to tell me what the risks are. Is the world economy overheating on a major scale? One very simple gauge of that is global industrial production relative to trend. Now, I'm going to leave aside the question of whether a linear trend is actually the right thing to be looking at in this case. But let's say that if you look at what happened prior to the 1990 recession, what happened prior to the tech bubble recession, what happened prior to Lehman's, in every single case, on this simple metric, the global economy was overheating. It isn't now. That's important. Other kinds of indicators that I look at are valuations of systemically important assets. We had a bubble in housing in the US. We arguably had a bubble in commodities prior to Lehman's. We had a huge increase in leverage in the financial sector. The 5-year moving average of risk appetite was in fact at all-time highs prior to the Lehman's crash, indicating that financial leverage had built up in the system. In the Western system. Doesn't apply now. So the preconditions that have been in place in Western economies prior to previous global recessions are not there. That's very, very important. Now, obviously, all of you are thinking immediately, yes, but what about commodities? What about China? What about excess capacity and potential debt overhangs outside the developed world? And of course, the emerging world and China are so much more important in terms of size and influence on global growth than they used to be. So I think we can probably say with some confidence that the conditions that normally apply in the West prior to global recessions don't apply now, and we'll go back to thinking that the main issue has to do with either commodities or to China. So we're going to explore that theme a little bit later. But before we do, I want to actually put this into even more historical context. And that is to talk very briefly about the 3 great crises of capitalism. We wrote an article in the Global Investment Returns Yearbook. There are some copies of that article upstairs if you want to look at it later. The article was published in February, and what I did there was to look at the 1890s, the 1930s, and the Lehman's crisis, and look for parallels and contrasts between what, for me at any rate, are the 3 great crises that capitalism has experienced. And it turns out that there are actually some very fascinating contrasts as well as similarities between those 3 crises. One of the contrasts is that in this crisis we had a much smaller fall in GDP, a much smaller fall in the price level than we did in the previous crises. But if you look at other metrics like industrial production or corporate profits, actually the crises look much more similar. You can also see parallels between the 1890s sovereign debt crisis in Latin America and what happened in Europe in 2011 and so on. Some of those things are explored in the article. Let me just give you a flavor, for example, of one metric which is surprisingly similar across the three crises, which is what happened to the real level of corporate profits using the Shiller series in the United States in each of those crises. So you can see that in 2007 to 2015, US corporate profits, which is this kind of turquoise level, on a headline basis actually fell more than in the Great Depression. On an operating earnings basis, just about the same kind of fall as we saw in the 1890s and the Great Depression, and you see the subsequent recovery, and you can see what's happening right now, that they're starting to wilt under the impact of the strong dollar and lower energy prices. You can also see something very interesting in that chart, which is that in the 1890s period, the recovery in corporate profits continued for quite a while. And you can see that in the aftermath of the 1930s, corporate profits recovered mightily, and then they fell very sharply at around about the period that we are now. So when I think about that, it kind of rather confirms my intuition that this year could turn out to be very good or very bad. Just to help you decide. Okay, here's another aspect of the three crises which I find fascinating. In every single one of these crises, including the current one, long-term bond yields, here US long-term bond yields, trended down all the way through the recovery from the crisis for several years, in fact for 7 to 10 years in the two previous cases, reaching all-time record lows at the end of that process. So you had economic recovery and nominal yields trending down. There is no other period in history I know of in which you can say the same thing, that you've had a long period of recovery and nominal yields are trending down in that way. So what does that tell you? It tells you that after these big crises, the system remains fragile for a very long period of time. That's kind of what it feels like today, doesn't it? The other thing you can see from this chart is that once bond yields got to record lows, there came a stage at which they first stabilized and then sort of went sideways to up. Not for 7 years, but for 2 to 3 decades. And you can also see that around about where we are in the sequence, in the 1890s, bond yields started to go sideways. Didn't really go up much, but certainly sideways. And that in the aftermath of the 1930s, around about 1937 would be for equivalent, actually bond yields trended back down again. Things got very bad again for a while. That was in 1937 because the Federal Reserve tightened monetary policy, the Treasury tightened monetary policy, and the Treasury tightened fiscal policy too soon after the initial very strong recovery out of the Great Depression. Inflation had just begun to, the price level, which had fallen 20%, had just begun to rise. The economy had recovered mightily. The equity market had recovered mightily. People started to worry about inflation before inflation was really a big problem, before the price level had got back to anywhere near where it had been before the crisis. And they were worried about the equity market overheating, and the Federal Reserve was worried about banks having too many excess reserves and what that might mean for future inflation. Sound familiar? The idea behind the policy tightening of 1937 was that a stitch in time would save 9, that it was more risky to delay tightening further until the stock market had overheated more, until inflation had started to rise, and so on and so on and so forth. It was more risky to delay than to do something now. Turned out to be a lot more risky to do something now than to delay. Now, in a sense, that history, that 1937 episode, is something which is seared into the memory of policymakers at the Federal Reserve. It's been much discussed, much studied, and so on and so forth. And one way that you could think about what happened in January, February was that those members of the FOMC who had kind of been losing the battle, they'd lost the battle last year. Last year, it was the guys who said, if we don't do something now, it's going to get very dangerous, and when we have to do something, when it's pushed the economy straight back into recession. They kind of won, and we got our rate hike finally in December. Immediately, the world economy, world markets went absolutely, went back into panic, and the balance of power swung away from that point of view. And we heard from Charles Evans yesterday at lunch that actually, hang on, we are aware of this risk, and so the balance of power has swung away from preemptive tightening back towards gradual, predictable, maybe 2 hikes this year, a little bit more if the economy is strong, maybe a bit less if it's not. So no need to preempt. That's actually a very, very important shift of policy, and it's particularly important for Asia because, as we know, US monetary conditions, US monetary stance can have a magnified effect on monetary conditions, growth, and asset markets in Asia. So let's draw one more lesson, or let's at least take the lesson of the 1930s, which is first, in the aftermath of these great crises of capitalism, policy really matters. Policy mistakes really matter. Number one. But there's another implication, which is kind of scary in a way, affects everybody in this room. And it's very simple, but it's the kind of thing that we think about all the time, but we probably don't do anything about most of the time. And that is, if you look at the pattern of returns for equities and bonds post these crises, and we did look at other countries besides the US, the data is a bit cleaner and it's a bit easier to read and summarize for the US, so I've used the US data here. But in this table, which may or may not be easy for you to read from the back, you can see the summary of what happened in the aftermath of each of these 3 great crises. And the numbers in bold are the things that I want you to focus on first. I can't do this for the table on the other side, but these numbers here and here and here. This is what happened to equity and bond returns in the first 7 years of recovery. In the case of the 1890s episode, real bond returns were about 6% per annum, and real equity returns were about 12% per annum. That is double the long-run trend. If you look at the 1932 to 1939 recovery episode, real bond returns were 5.5% per annum, and real equity returns were 19% per annum. And if you look at our recovery period from 2009 onwards, real bond returns were 4.6, and real equity returns were nearly 17% per annum. That is a long way. That's a long way above the historical average. Now, if we would focus on the red numbers, Here, this is what happened over the following decade. So first you have the first 7 years of recovery. What happens over the next decade? Well, it doesn't take a mathematical genius to work out that when bond yields get to record lows and end up going sideways to up after that, you don't get much return from bonds. In real terms, in the 1900 to 1910 period, it was minus 1% per annum, minus 0.8. Equity returns about the long run average of 5.7. In the 1939 to 49 period, which included Pearl Harbor, Second World War, all that, bond returns were minus 2.4, and equity returns were 3% per annum, about half the long run average. Now, the conclusion I take from that is if we look forward for the next 7 to 10 years, it's pretty likely that we're going to get zero, maybe slightly less than zero real returns from bonds. And maybe from equities, quite volatile, but somewhere between 3 and 6 is a pretty good working assumption. So about average, maybe a bit less than average. Okay, now let's just think about that. We've got the biggest generation retiring in the history of mankind. We have, in the fund management industry, a bias in favor of passive diversification. The default position for retirees is that you're 100% in bonds. And even if you just hold a balanced portfolio of 50% bonds and equities, over the period we've just been through, you were rewarded with returns of about 10% per annum above inflation. Looking forward, you'll get 2% if you're lucky. That is an amazing challenge to the fund management industry. It suggests that the strategies and the investment portfolios that we recommend and so on that have worked in the past probably aren't going to work in the future. We've got to come up with a different solution. Maybe active management will be necessary, alpha will be more valuable. Maybe we have to have a new concept of active diversification across strategies, across assets, across systematic, discretionary, passive and active. We've got to come up with something different if we're going to be able to offer decent returns to our investors. So even if you think we're not going into crisis in a cyclical sense right now, the fund management industry has got some thinking to do about the next decade, and track records, in one sense you could argue, need to be looked at with extra skepticism. You need to think very hard about what that track record is telling you about prospective returns going forward. Okay, if we go back to our main theme, I just want to go back to the idea that it's either very good or very bad. This is what happened to US real equity returns in the different crises. This is quite a long-term chart. It's about a 30-year chart. So what you're actually seeing there is that this, roughly where we are now, which you can see from the turquoise line, in the 1890s, you had a bit of a wobble and then a very strong recovery in equity markets. In the 1937 period down below, you can see that the equity market went down very sharply. In fact, the US equity market went down 50% from its peak in March to August of 1937. It went down 50% in 6 months as a result of the economy going back into recession, as a result of the premature tightening of policy that occurred in 1937. So that fits the it could be very good or very bad story, and this is the relative return of equities versus bonds. Again, more or less highlighting the forking path. Now, one final remark about the long-term outlook. That's looking backwards, trying to draw a few lessons from history that are worth bearing in mind as we go into the future now. If I look into the future, and it's very interesting, we had a discussion amongst other things at yesterday's session about productivity growth, which has been miserable recently in the US. But we also had a fantastic presentation about driverless cars and so on. And if I look at the world going forward for the next decade or two, what I see is the possibility of massive disruption to major parts of the world economy, of industry, that will have enormous effects on the equity market. The future of finance is not at all clear to me. It seems that both with the combination of demographics and aging is going to lead to banks looking very different 10 years from now than the way they look today. We all face enormous challenges on that front. If I look at the future of energy and transport, I mean, it's possible that we will move from a buy and own your car to a rent a vehicle whenever you need it model, that the average cost of traveling a mile will go down from 80 cents to 20 cents. And who knows where the big car companies, whether Tesla will make it, whether how that whole thing's going to work. We've just had an announcement from Saudi Arabia that they're going to invest a huge amount of money in transforming their economy so that in 20 years it is not principally dependent on oil. These are extraordinary changes, and a lot of them we will not see actually on the ground, for a long time. But what we can see is these things are starting to happen. And somewhere between now and 2025, they will transform our view of how those sectors work, and they will transform the value of the assets that are represented by the companies in the major stock market indexes in those sectors. That's just a couple. I could say the future of healthcare. Also, enormous changes. The future of food, of water, potentially, and so on. So these kinds of structural changes are going to be part of the world of investing and the global economy. And in a sense, they're even bigger than the issue of whether we're going into crisis over the next 12 months or so. But again, I would kind of submit that there is going to potentially be more room for active management than there has been in the past. Just sticking with a passive portfolio in a world which is going through that kind of disruption is potentially a recipe for disaster. So, having done all that, let's have a look at whether let's just try and think about this issue about whether the world is overheating again, going back to the cycle, and whether we've got to accelerate into our question at the end. Is anyone overheating? Well, if I look at the two of the world's major central banks, the ECB and the Federal Reserve, imagine that they had been running a price level target instead of an inflation target. That is to say, they wanted to hit a particular price level year by year, where price level is growing by 2% per annum. We start the clock with the beginning of the euro in 1999 on the left-hand side, and you can see that the ECB has indeed managed to control inflation, only perhaps a little too well. Core inflation is about 7% below target, headline inflation nearly 5% below target, and the current trend suggests that they're making absolutely zero progress towards getting back towards target. So they've undershot massively. If you look at the US, it's a similar story, not quite so bad. Core PCE is a more important policy indicator for the Federal Reserve. They're about 5% below target cumulatively. So one of the things that Charles referred to yesterday was not exactly this, because there's a bias against inflation level targeting, but he kind of said, we're doing quite well on our full employment mandate, not quite there yet, but we're actually not doing very well on our inflation mandate. And this is what he meant. And again, even though there has been a tiny little uptick in core inflation and wages just recently, you'd hardly say that they were getting anywhere near getting back to a price level target. In fact, they haven't got a hope of getting back to that target, really. So the question is there room for overshooting the inflation target? Is it a good idea? Is it risky? Is it not? And that's where you see a big divide in the Federal Reserve. Some people say inflation level target is a stupid idea, and they're ready to sort of be preemptive against any sign of higher wages and higher inflation, and they worry about being too late. And the others say, we've got all the instruments we need to control inflation if we have to. What we actually need to do is to go slowly, and given where we're starting, there's no rush. If you go back to 1937, my sympathies are with there's no rush. That's, I think, an important part of the background to this. Another area to look for overheating commodity prices, well, we know we're in the opposite condition to that. Here's a very long-term history of oil prices, which I've shown before. And for my money, I think this pattern here looks not unlike this pattern here. And I think there is a real chance that real oil prices in the medium term are going back to this sort of $20 a barrel sort of type, $20, $25 a barrel level. But you can also see that this period here, there was kind of several kind of spikes, and if we have very low oil prices now, the possibility of one final spike in this sequence before we end up there is certainly present. But the point I want to make just for the cycle right now is there is a sense in which oil prices overshooting on the downside now is actually more disruptive for global growth. It's not necessarily beneficial for US growth, and it's more disruptive for credit than having oil prices hold at above 35 or so, and then bounce and sort of trade between 35 and 55. That's a more stabilizing thing for global growth than having oil prices exploring down to 25 or 30 bucks. So for my money, whatever happens to other variables, oil still matters, and actually oil prices being too low is not that bullish for the world economy. It's arguably destabilizing rather than stabilizing. So we have an OPEC meeting on the 17th. I don't know what's going to happen. We probably won't have time to talk in detail about oil and so forth going forward, but what I would say is this, that there's a bit of a mystery about oil right now, which is there appears to be either stronger demand that isn't being fully recorded by the IEA in the emerging world, or an inventory build of some sort, which means that because there's about nearly 1 million barrels per day of missing oil out there, I don't think you should put a huge amount of faith on a huge deal between in OPEC to stabilize output. But if it turns out that oil demand is stronger than we are recording at the moment, maybe the situation, the glut isn't as bad as we think, and even small innovations in terms of controlling output can stabilize prices. In the very short run, as far as the equity market is concerned, I think oil is probably more important variable than China or anything else in terms of where we go from here. There's a lot more one could say about that, but I won't. Another aspect of are we overheating or not is simply looking at nominal investment. I think we've also had this theme in the conference so far. private sector investment and public sector investment is basically running below par in nearly every single major country in the world, except that if you look at China, and this is, by the way, all in US dollar billions, it's all nominal investment, which is a slightly odd thing, but you can see that here is the excess capacity, excess investment story that we might be worried about in China, that we are worried about in China. And I want to make 2 points from this. The first point is that I think something positive happened in Beijing at the G20 meeting. I think we heard about that also a little bit yesterday. I think Chinese policy is trying to do the right thing now more than it was before. What is the right thing? It's fiscal policy stimulus directed at projects that are sustainable and needed and properly thought out, used to help to support demand, while the government also provides tax incentives and other sort of support for restructuring and trying to begin to eliminate spare capacity despite some of the employment and social consequences that that will bring. And if I look at that excess investment in China, I think of that as being in the big industrial sectors, most notably steel. It's a global phenomenon. It's a global problem, as we see back in the UK with Port Talbot and so on. And I think they are now at least trying to do the right thing, but there is execution risk. And from my point of view, they're beginning to actually have a stimulative effect on the economy in the short run. So that actually, if you look at the data, both in the US and in China now, the manufacturing data, the latest data, is suggesting that we're actually picking up. And I think that that is true in terms of the short-term outlook for China. Now, whether that is sustainable and whether that policy can be carried through is a much more difficult question. But I'll just point out one thing. Just let's do a thought experiment. Suppose that you manage to have that successful combination of public sector investment that's relatively well targeted while you wind down some of the excess capacity in the areas where it's most egregious. Well, if you put some of those companies out of their misery and you insulate the banks against the effects of that, what happens to the prices of the commodities that those guys produce? Steel prices go up. That means that everybody else in the sector becomes profitable. That means that if there is successful restructuring, it's extremely dangerous to be short of the guys that survive. And we've seen one little episode of that in the commodity sector at the beginning of this year, and so on. So part of what needs to happen in this next phase of the global expansion is that we manage, the policy makers actually put a lot of effort into providing forms of stimulus that allow that restructuring and reform to take place. I think the Chinese are now trying to do that. Whether they can succeed or not, I'm not sure. But this is part of a more general theme about policy. We've had a lot of talk this year about the possibility that we've run out of ammunition, that monetary policies can't do anything more, negative rates won't work, QE won't work, and so on. One of the other lessons from the 1930s is that we came out of our crises partly because the public sector stepped in to invest when the private sector wouldn't. We have super low interest rates. We should be having more well-targeted, well-directed public sector investment combined with structural reform. China is just a template for what needs to happen in Europe, what needs potentially to happen in other countries. And that's what I mean when I say that policy really matters for the outcome this year. All right, one more thing, and then we're going to take a vote. If there is an unexpected or uncertain thing that is positive that isn't talked about by most people, I think it's this. It's this. This is a busy chart. It's hard to see. What it basically says is the trade cycle is 36 to 40 months long. Here's a stylized cycle, and what we do is we allow ourselves to reset the cycle in a major global recession when inventory liquidation takes place, and then we start the clock again. And for what it's worth, this says that we are reaching the point at which you would expect inventory reductions to have set us up for an upturn in the global industrial production cycle. And one possibility is that what this really is about is that falling commodity prices have led lots of end users to just let their inventories run down, and at some point, if we have successful structural reform and prices start to move up, they will start to need to actually increase those inventories, and there will be production, and there will be growth associated with that, and there will be pricing power associated with that. That's kind of what needs to happen to get out of this crisis and for us to have a very good year in stock markets. First, that we're stable, policy doesn't make the egregious mistake of tightening too early. And secondly, that we manage to combine stimulus with structural reform in a plausible way, and not just in China. And then that we begin to see some restocking in the raw materials sector, which helps industrial production to recover, and maybe investment stops falling in the commodity sectors and so on. So from an economic point of view, that's what needs to happen. Now, I haven't talked about Mr. Trump or Brexit or whatever. So my last remark is that what makes this year so difficult is that we are actually in a period when populism in politics is a real and present uncertainty and danger, and it scares the living daylights out of us. It's hard to be optimistic under those circumstances. Now, if you go back to the 1930s or the 1890s, every great crisis of capitalism leads to soul searching. Is capitalism the right thing? The rich and the poor, who's benefiting from growth? There is always a political reaction. Populism always is part of that. I think the really most significant thing about Beijing was that, I think, without necessarily saying it to each other, they all looked around at each other and they said, hello, big devaluation of the renminbi, Donald Trump. Big devaluation of the renminbi, Donald Trump. Maybe not this year. Okay, let's go back to a vote. Are we going back into crisis? Most likely. The yeas, yes, we're going back into crisis. Please raise your hands now. Oh, we've reduced the number by half. Those who think we're not going back into a crisis. Well, incurable bulls. Ladies and gentlemen, thank you very much.